All right. We're at this again live. My name is Brian Ullman. I'm a financial advisor here at Ford Financial Group. I'm joined today by Eric Simonians, another financial advisor here at the office. Eric's first time doing any of the, I guess we can call the social media stuff.
Yeah,
how's it going, Eric?
Time. Pretty good. It's my first time, I think, ever being live on social media.
Okay, well,
my camera just started working
for everything, right? What's that?
My camera just started working about 20 seconds ago.
Okay, well, good. Well, better late than never, right? Or better now than never. Well, good. Well, if you're watching this, welcome. We should be able to take comments if you are watching, and if you have questions, we can try and answer them in real time. For now, though, what we're going to do in the past on the Casual Friday is that we would go through a few charts and kind of chat about them. Take a look at what's been going on. Markets are closed for the week. S&P 500 was up on the entire month. We're done with April now, which is nice. Moving on to May, and we'll address that a little bit later. But for now, we're going to do something different than we've done in the past, which is we're going to, instead of trying to go over three charts, although I'll say, Eric, last time we did 3 + 1, so we did 4 anyway.
Yeah, it was 4.
Yeah. Eric has chosen 2 charts, and I've chosen 2 charts to go over. And so we can kind of chat about a couple of things that we found interesting this week. So, Eric, let's start with your charts. And the first one that you found interesting this week, which is a chart on jobless claims, right?
Yeah, I mean, I thought this chart was pretty interesting because it reminds me of just how nuts things were in March,
Right.
The market's just in complete turmoil, and, the sky is falling, and, people calling, everything's breaking. And then, I mean, it's how quickly things recovered, right? I mean, it was
sure.
I mean, what was it? Record multi-year lows to record highs in like 9 months.
Yeah, right. Well, it's funny because this chart is titled Jobless Claims in the U.S. have hit their lowest level in 15 months. But that doesn't strike me as the actual, that's like burying the lead. The lead is the peak, right? More than 6 million unemployment or 6 million initial unemployment claims
in 1 week
in April.
I mean, but also, like, looking at what I actually liked about it too was the kind of like the inverse of the recovery, right? Like the recovery of the market. And it kind of shows you like how the market is really forward looking, right? It's not really based on current conditions.
Right.
And you kind of see the lag. It's like the market already saw an end to this way back last year. And just now you're starting to kind of see it actually happen.
Right, because the market bottomed last year at the end of March. Right. So well before jobless claims even peaked. And by the way, even though they peaked in April, they were really, really high in June and July last year also. Yeah. And it looks like at this point, we're still about double where we were for the 2019 average. But
I mean, I think there's still
the rate of improvement is good.
Yeah, I mean, I think there's still 6 million people that are unemployed, right? But, it's new claims at a decreasing rate. And
sometimes it's not about the number, it's about the trajectory.
Yeah, exactly.
Wouldn't you say? Yeah, I think you picked a good one. Now, this is from Charter, and they use the Federal Reserve of St. Louis as their source for this. And so you can get these unemployment claim numbers kind of anywhere, but I think you picked a good chart so we could see in very clear terms with this blue line exactly.
I see a lot of charts with these spikes one way or the other whenever you're looking over the past year.
Yeah, right. It's either a crater or a mountain, but one of the two. Absolutely. Well, that's good. I think you picked a good one, not just because it shows the latest initial unemployment claims, but because it puts it in perspective the way the last couple of years have gone with initial unemployment claims. Well, good. Well, we're going to move on to the next one that you had here. I'm going to choose. Let me see if I can grab the right one here. I thought you picked an interesting one because this was the first 100 days. Was it? Yeah, I think it was yesterday. The president had his first 100 days in office, and so this is pretty relevant for what went on this week. Why don't you run down what you see here?
Yeah, I mean, I thought this was a pretty cool chart. I'd never really seen like the information broken down like this before. And talking to clients all the time, we've got clients on both sides of the aisle.
Sure.
And whatever your political views are, there seems to be this thought that Republicans are good for the stock market, Democrats are bad for the stock market. But when you look at this chart, money's not red, it's not blue, it's green.
Yeah.
So it's pretty much, it shows a lot of growth, no matter
politically agnostic, maybe you could argue.
Exactly.
Right?
And I mean, it kind of reminds me too, not to digress a little bit, but like back in 2016, I was working at the trade desk in the home office, and we always make preparations for any kind of potential market event.
Sure.
And of course, the election night was something we were concerned about what the impact would be on trade volumes and stuff like that.
Right.
And you're watching the election on TV, and there's this tiny little box in the little right hand corner. It's a Dow futures.
Yeah.
And as the night's going on, that box starts getting bigger and bigger, and your phone starts ringing. And my boss is like, "Are you watching the futures?" Oh my god! It's like, "Oh, tomorrow's gonna be." Oh my god! And then maybe 2 a.m, and I was like, "I gotta go to bed. I gotta be at work in 3 hours."
Yeah.
But
I did the same. Same thing. Well, you're watching futures, and it's like down 100 points, or the Dow was down 100 points, 200 points, 300, 400 points, and you're like, "Oh,
I think it was 900 at some point."
Well, yeah. So you reach the point where 400 and 500 points, you're like, "Oh man, we're in for a day tomorrow." And then you get to 800 and 900 points, 1,000 points on futures, and you're like, "Okay, this is crazy. We've turned from like pretty ugly to opportunity."
Yeah,
in a matter of hours, right?
And that's what happened. I mean, went to work the next day and ended up being a pretty good day.
Yeah, like the market wasn't even down too much when it even opened on.
Yeah, it was up to 1%, I think, on the day, if I remember.
Yeah.
But it kind of goes to show you too, like you can't win if you don't play. Just getting your money out there is important.
I think it's interesting because it's like you were saying, money doesn't care. If you look on the Dow return for the rest of the first turn, you go back. This is going back to 1901. The entire first term of someone's presidency, there's only been 3 times that the Dow finished in the red. I mean, that's crazy.
I've never seen that presented before, and yeah, it's a encouraging chart, definitely.
Absolutely. And you can even see it doesn't even seem like the 100-day return for the Dow is even correlated to the rest of the term, right? You can go back, look at Ford, down 17.5% first 100 days, up 49% for the rest of the term.
Yeah, if you do a dot chart on that, you're not going to see any much correlation between the two.
No, that's good. Well, I know presidents, no matter what stripe, like to take credit, don't want to take blame, but like to take credit for whatever the market's doing. But the market is digesting so much more information than what's going on in the White House or even in Washington. It's influential, but it doesn't dictate which way markets go.
Yeah, I mean, markets are really just it's fundamental what drives them. What's really happening. It's not the people in power necessarily that are driving that stuff.
Absolutely.
But they will take
credit. I think you picked a winner. On this one. I like it. So let me jump out of this. Because we are going into May, I'm going to just give me a second. I'm going to pull up the other charts that I have. So the first one I want to share has to do, there's an old saying of sell in May and go away. It's one that's been, it's been around forever, right? It's been around forever. And the reason being is because you can kind of see here in this chart, this is from LPL. It goes back to 1950. You can look over the 6-month periods. So this isn't month by month, but say various 6-month periods. And May to October is always, or has historically been the last, 70 years, the weakest 6-month period. Its average change is only up 1.7%, and it's up almost 65% of the time. And you can even look April through September, which is another a very close stretch of time, also up a percent higher, about the same amount of time. So like this very clearly demonstrates the summer months for the S&P 500 are the weakest. I mean, it's crystal clear.
I find that myself personally, I'm least productive during the summer months also.
Well, I think, I think markets can get a little bit more volatile because trading volume is a little bit lower. Like, people who trade there, it's people, it's not some nebulous market thing. And so if people aren't minding things and they're away from their trading desks or their phones now, perhaps that's one of the reasons why things kind of fall off a little bit. And you're about as far away from the holidays as possible. So the seasonal hiring may kind of go away. Consumer spending might ease off a little bit. I imagine there's a whole host of reasons why the summer is the weakest. I will say though, what's missing here, it shows red here, and it's because it's the average percent of change and the percent of time that this is higher is the lowest from May to October. But you'll notice it's still positive. Don't be tricked by the red color on this graph, because the average return between those months is still almost 2%, right? For the S&P 500, and it's up well more than half the time.
Can't win if you don't play, right?
I like those odds. Yeah, absolutely. Absolutely. I will take that. If someone told me you'll be up in the market almost 65% of the time, you can count me in. And timing, I haven't had this chart, but timing the market absolutely doesn't work if you really do sell in May and go.
It'll work once, and that'll be the worst thing that could possibly happen to you.
God, if someone tries to time the market, what you almost don't want it to do is work that one time, because then you're under this false notion that actually works. But it's one thing that I didn't include in here is that August is pretty consistently bad, and August is captured in these two lower categories here. So I thought this sell-in May, we're in the end of April, so I thought the sell-in May stuff was kind of interesting just because you hear it from time to time. And it is the weakest, and so there is some truth in the saying, but it doesn't mean it's actually true.
That Santa Claus rally looked real.
Wait, let me pull this back up. The November to April, October to March. Yeah, there's no doubt that the fourth quarter and the first quarter are the best two quarters of the year. I mean, there's just it's got markets always seem to have that cadence, right? You come out like a shot to begin the year, things get a little bit haywire over the summer, and then usually in the fourth quarter, with the exception of 2018, things rebound. So markets do seem to have a cadence to them sometimes. So speaking of selling May and go away, the other chart that I wanted to share with you here was the looking at May to October over the last decade, because that last chart we were looking at went back for the last 70 years. This is looking at the last 10 years. You look year by year. I have an old law school professor that used to say you always have to slice the bologna thinner, because you look at the big number and it doesn't, there's lies, damn lies, and statistics. And so you look at the big number and it doesn't always tell the story. So you look these last few years of the S&P 500 returns from May to October over the last decade. This is better than the 65% that we were talking about. It's higher 80% of the time. And on average, it's up 3.8% of the time. So, and even last year we were coming off a cannonball.
Yeah, take the outliers out. It's still good. It's still
good. Yeah, absolutely. Yeah, you got to take the outliers out. But even then, taking out the outlier would lop off that 2011 kind of uneven rebound from the Great Recession that we were having. What was 2011? U.S. credit was downgraded, I think, that year.
Or it was on the watch list. I don't know if they actually.
That's right. That's right. And Greece was trying to go bankrupt. The good old days of the recovery from the Great Recession. Yeah. But this tells not just do things tend to work okay over the summertime in the last 50 years. They've actually done pretty well over the last decade. So
these are solid returns. I mean, anything
right
in the green is better than burying it in the backyard.
Yeah, right. Well, I almost did an inflation chart I showed you.
Yeah.
Maybe we'll save that for next week, because I
love that chart.
What you definitely don't want to do is bury it in the backyard, because if you think about investing at its most basic, you're trying to keep up with inflation so you maintain your purchasing power. These returns certainly do that. And so, selling May going away is fun to say because it rhymes, but it's not true.
Bump that here We've debunked that theory.
That's right. That's right. You've tuned in live and seen it here first, maybe. But have you had anybody calling you and saying that they're a little twitchy about headed into summer with markets?
Yeah. They're always saying, I don't know what's going to happen, but to be honest, no one really ever knows what's going to happen. Things are too good, they get nervous. Things are not so good, people get nervous. It's just best to stay the course.
I get the sense from folks I talk to that it's not so much that they're worried about sell in May and go away, or the summer months aren't good. It's more that they're concerned that things have gone well for too long. So it's too good, waiting for the shoe to drop, which kind of falls in line with the summertime worries. But markets don't go down just because they've gone up already either.
And when they go down, it's it's painful and scary, but those are your best opportunities.
Sure. Well, how many years did you spend on the trading desk at LPL?
15, I think.
Yeah. So you've seen a few of these.
Yeah.
Yeah. Right. Well, good. Well, I think this was cool. And I think a little bit more interesting than the last couple of runs. We're always, as I said last time, we're always trying to sand off the rough edges of this because I think it's useful for people to hear kind of in real time what's going on and what we find interesting. And so, we'll have to do it again.
Yeah. I hope you invite me back.
Yes, I will certainly invite you back. This is for both of us. Absolutely. Well, good. Well, Eric, have a good weekend. And, we'll see you on Monday.
Take it easy.
All right. See you later. Thanks for watching, everybody.